Okay, so flexible budget variance and management control part two, and that's chapter number 8. Let's start and see that what we're going to cover in this chapter. What are the learning objectives of this chapter? Now, if you look at our analysis, what we discussed in our previous chapter, uh, we focus only on the revenue side and on material. And when we discuss the level 3 analysis, we focus on material and manufacturing uh, uh, labor, or we can say it's a direct material, direct labor. And but here in this particular chapter we are focusing on manufacturing overhead, and we further break it down into manufacturing overhead fixed cost and manufacturing overhead variable cost. So that's the main difference between this chapter and the chapter we already discussed. So how do we assign manufacturing overhead? MOH means manufacturing overhead. Fixed cost, then calculate and analyze flexible variances of this manufacturing overhead fixed cost. Establish variable overhead cost allocation rate, calculate and analyze flexible budget. So as I mentioned, our focus is only on manufacturing overhead fixed cost and manufacturing overhead variable cost. Then we also discuss a little bit about the ABC, uh, activity-based costing system, overhead variance in that case. Integrate the fixed and the variable overhead cost variance analysis to reconcile an actual overhead incurred with the overhead allocated. And then we also going to discuss about non-manufacturing variances as well. Like we have to because when we are evaluating the performance of our employees, or a performance of a particular department, or a performance of a particular division of the business, we are not just focusing only on the figures or the data we are getting. We have to see from the perspective of non-manufacturing variances. For example, like if there is a lot of rework, like the products are coming back from the customers with a rework to improve it, guarantee claims, returns, complaints, and or without going into the customer's hand, if we need to do rework on it. So if these are the things, then it means that the performance is not up to the standard. So we have to look at what possible things that we can focus, or the management should focus on the variance analysis. So variable overhead as efficiently as possible, plan only essential activities. So when we are discussing variable overhead, that we try to get as much as possible with efficiency, and only focus on essential activities. Fixed overhead as efficient as possible, plan only essential activities, especially because fixed costs are predetermined. Fixed costs are not so variable well before the budget period begins. So here we see that fixed manufacturing overhead variance, and we see that there's an actual cost incurred and the same budgeted lump sum as in static budget. That difference is called as a spending variance, right? That's the difference between the budgeted lump sum, or in a static budget, the actual incurred fixed manufacturing overhead, and the budgeted static budget uh, amount allocated for manufacturing fixed overhead. The difference is our spending variance. On the other hand, when we compare the flexible and the budgeted, flexible amount allocated as a manufacturing fixed manufacturing overhead, and the budgeted ones, or input allowed for actual output into the budget rate. This is allocated. Budgeted input allowed for actual output into budgeted rate. That what we call it as a production volume variance. So there are two types of variances: spending variance and projected volume variance. And there is no variance between the static and the flexible budget because it's a fixed cost, right? So the reason that we have to. If we compare this flexible budget with an actual, we call it as a flexible budget variance. We already know and we discussed this. And the difference between flexible budget and the allocated budget or the static budget, that's what we call it as a production volume variance. You remember that sales volume variance when we compare the static and the flexible. So here we are focusing only on a manufacturing fixed overhead. So for that reason, we are named it as a production volume variance. And overall, the difference between allocated and the cost is the total fixed overhead variance over or under allocated fixed overhead. So this way that we can analyze it on the fixed one. Fixed one is analyzed this way. And the variance, overhead variance, MOH variable. So overhead variance is the most difficult cost to manage and is least understood. Why? Because it is fixed. It's very hard to identify that how we can reduce it. So overhead variance involves taking difference between equation as the analysis move back and forth between actual results and budgeted amounts. Planning fixed overhead cost, fixed manufacturing overhead cost is a capacity cost, and the capacity cost is not easy to change. So the quantity of output that can be produced from available long-term resources, and it's a strategic decision that how much you anticipate that in a 5 year or in a 10-year plan, that how much your output is going to increase. So capacities are determined and measured, and this is it's not just a decision for a 1 year. It's a decision, is a static decision in which a long-term planning is involved. So cost of capacity is recovered through sale of output goods and services. Both the costs are inventoryable, like what we discussed in our ABC, and period cost, capacity cost exists. Now, developing budgeted fixed overhead cost rate. So when we are developing the rate, like how we or the cost drivers, so choose the period to be used for the budget. Select that's a budgeted period. Select the cost allocation basis to use in allocating fixed overhead cost to output produced. And identify the fixed overhead cost associated with the each cost allocation base and compute the rate per unit of each cost allocation base used to allocate fixed overhead cost to output produce. Now, fixed overhead spending variance, just what we discussed here, like a spending variance, the difference between actual cost incurred and the same budgeted or a strategic budget, regardless of the level of output. So the fixed overhead spending, flexible budget variance is the difference between actual overhead fixed cost and budgeted fixed overhead cost in the flexible budget. So there is no fixed overhead efficiency variance. Why? Because it's a strategic decision. It is fixed for a longer period of time. So capacities cannot be altered very easily and very quickly. So fixed overhead static budget variance is an actual cost incurred minus static budget amount as a result from paying more or less than expected for overhead items. Budgeted fixed overhead rate, that how we find out the budgeted rate. So budgeted fixed overhead cost divided by budgeted quantity allocation based unit. And this both are we are using to figure it out the now, difference between budgeted fixed overhead and fixed overhead allocated on the basis of actual output produced, also known as a denominator level variance or a budget output level overhead variance. So how we can figure it out? Production volume variance. You remember that here we also discussed production volume variance, how we figure it out, production volume variance. So here we are discussing production volume variance, like budgeted fixed overhead minus the fixed overhead allocated to actual output, multiply by the budgeted fixed overhead rate, which we determined here, fixed budget overhead rate. That's a result from operating at an activity level different from the denominator activity level. So if we are producing or doing activity different than the denominator level of activity. What is the interpretation of these figures? Interpretation of this variance is difficult due to the nature of the cost involved and how they are budgeted. Fixed costs are by definition somewhat inflexible. It makes no sense to do flexibility. While market conditions may cause production to flex up or down, the associated fixed cost remains the same. So fixed cost may be set years in advance and maybe so. As I mentioned, that it's a strategic decision. Fixed manufacturing overhead is cannot be altered or changed very quickly. Here is a real figure from an example we just discussed. That actual factory manufacturing overhead cost pool, that's a whole pool of manufacturing overhead, uh, 285,000, and the flexible and the static uh, factory manufacturing overhead, fixed manufacturing is a fixed manufacturing overhead. So the difference is called as a rate variance, and which is 9,000 unfavorable. And when we compare, this is a production volume variance between the flexible and static fixed manufacturing overhead, allocated quantity of fixed direct manufacturing hours. That's a driver we are using for 10,000 jackets into the rate of direct manufacturing hours. So while this way we figure it out that it's a 230, and we get it an unfavorable production volume variance, which is 46. And when we combine these two, because both are unfavorable, so we get it 55 under allocated fixed manufacturing overhead. Now, the second part of this topic is variable overhead variance, and we see here that variable variance overhead, uh, variable overhead variance is actual cost incurred. That's again from the actual figures. Then actual input into budgeted rate. That is what we call it as a flexible budget. Then we have a budgeted input allowed for actual output into budgeted rate. That's a new figure we are figuring. And that's a budget input allowed for actual output into budgeted rate. So if you look at this, the flexible budget and allocated are the same thing. So for that reason, there is no variance because these are both same. The only variance we find it about the flexible budget is efficiency variance. We discussed a little bit in our level 4 in our previous chapter, and there's a spending variance. We already discussed this in our when we are discussing the material, when we are discussing the manufacturing labor. So for variable overhead variance is also the same like spending variance and efficiency variance. And altogether, we see that the flexible budget variance, and there is no efficiency variance in this here. So only flexible budget variance. And total variance overhead, whether it's over or under allocated variable overhead. Again, the same what we applied for a fixed manufacturing overhead. We are also for a variable also choose the period to be used, select the cost allocation basis, identify the variable overhead cost, and compute the rate per unit. How do we do this? The formula for finding out the difference between actual quantity of the cost allocation base used and budgeted quantity of the cost per unit of the cost allocation base. So variable overhead efficiency variance is actual units of cost allocation base used minus budgeted unit of cost allocation based allowed into budgeted variable overhead cost allocation base. So this is controlled by managing the overhead cost driver. And similarly, the different variable overhead spending rate variance. How do we get this rate variance? Because we need to calculate the rate variance in order to figure out this rate variance and efficiency variance. So rate variance difference between actual and budgeted variable overhead cost per unit of the cost allocation based multiply by the actual quantity of variable overhead cost allocation based used for actual output. And by this way, we get this formula that a variable overhead spending variance is equal to the difference between actual variable overhead cost per unit of the cost allocation base minus budgeted variable overhead cost per unit of cost based allocation base into actual quantity of variable overhead cost allocation base used. What we get it from there is paying more or less than expected for overhead item and from excessive usage of overhead item. So that's going to give us that whether we are paying more or whether we are using excessively. So this is a rate variance we are getting. That's we are paying more or less, or this is efficiency is an excessive use or wastage of resources. So that's so these both this is favorable. The rate variance is favorable. The efficiency variable is unfavorable. So by combining these two, we get it at this which is flexible budget variance unfavorable. Variable overhead rate and efficiency variance can be calculated for each level of cost hierarchy under ABC, output level, batch level, product level, or a facility level. And when here is an example like Le Cost Brass Works is calculating rate variance, which is unfavorable, and efficiency variance is also unfavorable. So the flexible budget variance is unfavorable altogether. Fixed overhead spending and production volume variance can be calculated for each level of cost hierarchy. So we see here that we are calculating rate variance for batches, that is for batches. And recall that for a factory manufacturing overhead, a rate variance equals the flexible budget variance, which equals the strategic budget variance. So this is a batch level, batch of 150. So we see that this quantity is a batch level quantity, and we see here that under allocated fixed overhead for ABC. 3 and 4 variance analysis present fixed and variable overhead variance in a single compact report. Three variance analysis is a variable overhead spending variance plus total overhead efficiency variance combined variable and fixed plus fixed overhead volume variance, that is called total overhead variance. Four variance analysis for total overhead variance is variable overhead spending variance plus variable overhead efficiency variance. Uh, Fixed overhead efficiency variance plus fixed overhead volume variance. This is called 4. So you see here, we adding up three variance analysis in order to get three variance analysis. And when we add up 4 with the fixed overhead efficiency and volume variance, then it becomes a 4 variance analysis. The last thing that we want to cover here is, as I mentioned in the beginning as well, like we want to cover non-manufacturing variance analysis. Non-manufacturing variance analysis is a variance previously discussed has been examples of a financial performance. It relates to the profit, it relates to the costs measured related to manufacturing. But non-manufacturing measures also important for assessing performance. For example, market share, on-time delivery, customers retention, customer satisfaction. Strive to reduce non-value added cost, reduce cost, but not the value customer obtained from the product or services. So these are non-manufacturing variance analysis we have to do for in order to figure it out the performance of our particular department or services. So this is all what we discuss for today topics. The takeaway, the main point on which we emphasize here is that we have to do variance analysis in order to figure it out why we are off the budget, our static budget. Now, when we get these values that we are this much far from our budget, then we have to further deep down this analysis in order to figure out where uh, uh, and why we are away from our targets. So this is a whole analysis. Mostly our emphasis at this level, of course, is that you must understand and know how to calculate zero level analysis, level 1 analysis, level 2 analysis, and up to the maximum level 3 analysis. So you should aware of this. You should be prepared to make flexible budget. Now, flexible budget is again very important to understand for this analysis, like actual activity level with the budgeted rates, with the budgeted dollar figures. So that's the way that it's gonna be work. I hope you enjoy this video because I want to make it productive when you watch it. Uh, see you next week. If you have any questions or any concerns regarding the course, so you should email me. I will try to reply as soon as possible. So thank you very much and have a good day.